Meet Michael Burry. He's a physician turned hedge fund manager with one functioning eye, an autism diagnosis he credits for his obsessive research habits, and exactly one trade that made him a legend. In 2005, while every bank on Wall Street was printing money on mortgage bonds, Burry sat in his office in San Jose reading the actual loan documents inside those bonds. Not the summaries, not the ratings, the documents. And what he found was so alarming that he did something nobody had ever done before. He called Goldman Sachs and asked them to sell him insurance against a housing collapse that the entire financial system was certain would never happen. Goldman thought he was insane. They sold him the contracts anyway because free money is free money, right up until it isn't. 2 years later, Burry made $100 million personally and $725 million for his investors. The housing market collapsed. The global financial system came within 72 hours of complete failure. And Michael Burry became the most famous contrarian investor alive. Now he's shorting Nvidia. And before you decide whether that's genius or madness, there are a few things about this trade that almost nobody is talking about. Because the version of this story you've probably heard, man who called 2008 bets against AI, is accurate but incomplete. And the incomplete version is missing the parts that are actually alarming. So let's start with what the trade actually looks like, because the structure of it matters. Burry isn't just bearish on Nvidia the way someone posts a tweet saying this feels overvalued. He holds 2 layers of put options. Earlier, $100 strike puts, and more recently disclosed $115 strike puts expiring January 2027. With Nvidia currently trading around $188, the $115 strike sits roughly 39% below the current price. Factor in the premium he paid, $3.30 per contract, and the break-even is around $111, meaning Nvidia needs to fall approximately 41% for this trade to make money. He chose long-dated options specifically to avoid the brutal borrowing cost of outright shorting a $5 trillion stock. His framing: the options cost him roughly 3% of notional value to hold, which is a bargain compared to the carry costs of a traditional short in a stock this hot. So the question isn't whether Burry is bearish. The question is what he actually knows that justifies a 41% decline target on the most important stock on earth. And here's the thing. His thesis isn't really about Nvidia at all. In November 2025, Burry published a series of posts laying out his actual argument. And it wasn't Nvidia's chips are bad, or AI isn't real, or any of the things people assume a Nvidia bear would say. His argument was an accounting claim. Specifically, the companies buying Nvidia's chips, Meta, Amazon, Microsoft, Google, Oracle, are reporting fake profits. And they're doing it through a mechanism so boring, so buried in footnotes, that it almost guaranteed nobody would notice. Here's how it works. When a company buys a large physical asset, servers, chips, data center equipment, it doesn't expense the full cost immediately. It spreads that cost over the estimated useful life of the asset. This is called depreciation. If you buy a $90 million batch of Nvidia chips and you estimate they'll be useful for 3 years, you record $30 million in depreciation expense per year. But if you decide they'll be useful for 6 years instead, you only record $15 million per year. Your reported profit just doubled. The asset didn't change. The cash didn't change. You just changed a number in a spreadsheet, and your earnings look dramatically better. Now here's what Burry found. Every major cloud company, Burry calls them hyperscalers, has been extending the estimated useful life of their GPU hardware, not shortening it, which is what you'd expect given that Nvidia releases a new generation of chips roughly every 2 years, extending it from 3 years to 5, from 5 to 6, from 6 towards 7. And because Nvidia's chips are becoming obsolete faster with each new generation, Burry argues the real economic useful life is closer to 2 or 3 years, not 6, which means the depreciation these companies are recording is a fraction of what it should be, and the profits they're reporting are inflated by the difference. By his math, that difference across the industry adds up to $176 billion in understated depreciation between 2026 and 2028. $176 billion in profits that don't actually exist. He singled out Oracle and Meta specifically, estimating their reported profits could be overstated by 27% and 21% respectively by 2028. This isn't a rounding error. This is, in his exact words, one of the most common frauds of the modern era. And here's the part that makes his argument harder to dismiss. Amazon already quietly moved in his direction. In early 2025, Amazon shortened the useful life of a subset of its servers, the opposite of what every other hyperscaler was doing. The company with the largest cloud footprint on Earth made a small technical accounting change that almost nobody reported. But in the context of Burry's thesis, it's the defendant changing their story mid-trial. It's not proof. but it's a tell. Which brings us to why this trade is structured the way it is, because Burry's actual bet isn't that Nvidia's stock falls tomorrow. It's that the accounting fiction catches up with reality before January 2027. If the hyperscalers are forced to shorten their depreciation schedules, either by auditors, by regulators, or by the market finally doing the math, their reported earnings take a significant hit. Suddenly, the companies spending $700 billion a year on AI infrastructure look less profitable than advertised. Demand for Nvidia chips starts getting questioned. The AI capital expenditure cycle, which is the entire premise of Nvidia's $5 trillion valuation, starts to wobble. And Nvidia's stock, priced for a future where everyone keeps buying more chips forever, starts to look like it's priced for a future that was partially made up. That's the chain. And it's not crazy. It's actually extremely specific. But now we need to talk about the part of this story that complicates everything. And it's the part that the Burry called 2008 framing conveniently leaves out. Michael Burry has been wrong a lot. Not occasionally, not in edge cases, systematically and repeatedly for most of the last decade. In 2017, he predicted a global financial meltdown and invoked the possibility of World War III. The S&P gained 19% that year. In 2019, he told Bloomberg that index funds were the next CDOs, that passive investing was creating the same kind of systemic bubble that subprime mortgages had before 2008. Nothing like that happened. In 2021, he called it the greatest speculative bubble of all time. Markets continued higher. He shorted Tesla at the wrong time. He issued a sell call in early 2023 that proved premature. Out of 14 major public predictions between 2017 and 2023, roughly 71% turned out to be wrong. When he finally closed his fund in late 2025, he said his estimation of value in securities is not now, and has not been for some time, in sync with the markets. That's a very careful way of saying he's been wrong for years. And he knows it. He named his new newsletter after Cassandra, the Greek prophet cursed to be right, but never believed. He's aware of the irony. So how do you reconcile the man who saw 2008 coming with the man who's been wrong about almost everything since? Here's what I think is actually happening. And it's something almost nobody talks about when they cover Burry. The 2008 trade worked not just because Burry was right, but because he was willing to be wrong for 2 years first. He started buying CDS contracts in mid-2005. By late 2006, he was underwater, paying premiums on positions that were generating nothing but losses, fighting off investors who were threatening to sue him, getting letters demanding redemptions, being told by every counterparty that the trade was insane. The banks that sold him his contracts were actively manipulating the pricing to keep his positions underwater and protect their own balance sheets. He held anyway. The housing market finally cracked in mid-2007. The full collapse came in 2008. The trade worked, but it required being publicly humiliated for 2 years before it did. He started buying Nvidia puts in mid-2025. His expiry is January 2027. He is currently in month 8 of what is structurally the same playbook. Long-dated options, a specific thesis he's researched obsessively, a market that thinks he's wrong, a position that's currently underwater, and a timeline that requires holding through the pain. Whether you believe the thesis or not, you have to acknowledge that he's built for this. This is not a man panicking into a trade. This is a man who has sat underwater on a position for 2 years before and came out the other side with $100 million in his pocket. Which brings us to the uncomfortable truth. The problem with Burry isn't that his analysis is wrong. It might not be. The $176 billion depreciation argument is specific, documented, and already being partially validated by Amazon's own accounting changes. The problem is that being right and being right on time are two completely different things. And in options trading, there is no version of being right too early. There's just losing. His January 2027 expiry gives him roughly 12 more months from now for Nvidia to fall 41%. That's the window. If the accounting unwind he's predicting takes until 2028, the options expire worthless and he loses the premium. If Nvidia keeps grinding higher, same outcome. The thesis survives. The trade doesn't. And here's what makes this specific moment genuinely interesting. Burry's $115 strike price isn't random. It's almost exactly where Nvidia's stock traded when the DeepSeek panic sent it crashing in January 2025. The market looked at $115 Nvidia, decided it was an overreaction, and bought it back to $188. Burry is saying the market was wrong to bounce. That $115 wasn't panic pricing. It was a preview of fair value. That the number the market ran away from in fear is the number it's slowly, inevitably heading back toward. Maybe he's right. Maybe the greatest accounting story of the AI era is hiding in a depreciation footnote that nobody read. Maybe the $176 billion in fake profits unwinds exactly the way he says it will, on exactly the timeline he needs. Or maybe markets can remain irrational longer than his options can remain solvent. And the man who named himself after a prophet nobody believed ends up being exactly that. Do you think A. Burry's depreciation thesis is the real story of the AI bubble, the accounting unwind is coming, and in 18 months we'll look back at this Substack post the same way we look back at his 2005 mortgage analysis? Or B. The 71% wrong track record is the real story. The man is a chronic bear who got famous for one trade and has been chasing that feeling ever since, and Nvidia hits $300 before his puts expire. Or C. The option I find most interesting. The thesis is right, but the timing is wrong. The depreciation unwind happens eventually, but not by January 2027. The options expire worthless. And Burry is vindicated in 2028 by a market crash he couldn't quite hold on long enough to profit from. Drop your take in the comments, because this one is genuinely too close to call.